And the first half of 2023 has been quite interesting for the fixed income market space, as it was characterized by several issues such as the forex market liberalization, rising inflation, subsidy removal, unattractive yields, and many others. To give us a review of the period ended and an outlook of what to expect for the second half of the year, we have joining me now Bankole Odusonya, Chief Dealer at Polaris Bank, joining me via Zoom. Great to have you on the show. Good evening.
Good evening.
So tell me, how have policy changes impacted the markets, FX and interest rates so far?
Yeah, I'll start quickly by telling you the two quick wins that we have seen in the market. One being on the exchange rate liberalization, where there's been a convergence. We're not having 4 or 5 rates as we used to have. There's been a convergence to the range of about 770, 780 that has been achieved. However, there's been some level of illiquidity where there's more demand than supply. So as we speak, there's some anticipation of international oil companies who have export proceeds being allowed back into the I&E market, because that's the aim of the government, and that's the announcement by way of communique, that all buyers and willing sellers should converge at the I&E market. Once this happens, if the international oil companies come back and start selling their export proceeds, we expect to have a fine balance where even speculators would then start selling, because once the liquidity comes back, the prices are definitely going to be more stable and then moderate further. So on the interest rate side, there's been a removal of the asymmetric corridor around the overnight market placement, the interbank placement market. So what that did was to crash rates to as low as 1% and then drop treasury bills yield trading, discount trading to about 5%. So the drop in those yields simply means that surplus fund holders like banks and other participants in that sector would have to look for real sector investments like risk assets and loans creation. The government was always concerned about how high yield government securities were, and then that concentration simply took out funds away from the real sector. So low yields and having a very positive curve where bills and overnight placements were very low, and then for bonds we've seen a drag down of yields from 16 to about 14% from some long end, and the mid end we're beginning to see bonds at 10 and 11. So those moderations simply mean they become less attractive, and their fund holders start looking for real sector opportunities, especially on the loan, issuing loans out to the real sector. So that's another win, quick win for this administration going into the second half of the year.
And how's the market reacting to the FX liberalization and I&E markets, announced last month, by the president? Looking at, foreign investors at this time, is Nigeria a buy with this unification?
Nigeria is definitely a buy, especially with the return of the futures, the NDF futures market. It's like a hedging tool where you get some form of insurance against your long-term FX desires. So basically, they do not deliver dollars, but at least it gives you some kind of insurance that, okay, if you're buying away from market, you get a Naira compensation. So it's very good. Most of our foreign partners were calling us initially when the prices were put off for a few days, but now that it's back since Monday, it's positive vibes. And we're beginning to see more offers in the market. It's just that we're having more demand than supply, and then prices keep, ranging from 760 to 770, and then we'll be touching. There was a lot of deals being done at 782 levels. But the key thing to notice that since the liberalization happened, you notice that the alternative market, which people call parallel market, hasn't really moved. So that was the market, and it hasn't really moved. Deals are still being done at that level, and then the I&E market is becoming more active day by day. Even the central bank in itself has kept on, coming to be a participant there. We expect more from them, and then once the international oil companies get back to that market, we expect serious liquidity to kick in, and then some more price stability. We can't say of strengthening of the Naira for now, but we can guarantee you of stability once the international oil companies get back to that market.
Let's look at the inflation story right now, about over 22%, at this time. Is this going to discourage investors, at this time, looking at most of the yields about 10%. Don't you think they'll want to get as high as maybe 20%, to get attracted back to this market?
That's been the speculation, but if you look at the bonds market, there's still some very nice yields at between 13 to 15% range. There are promissory notes of 24 to 36 months, ranging from 12 to 14, 11 to 13%. So we do not consider that as terrible. Before the FBI's, left the country upon the JP Morgan index removal and then COVID 2020, these were the levels we were trading, and that's our argument, that we were never at 20 when they were around. So we believe these levels are still attractive if we have more laws, and policy guidance that are very favorable. The other issue is that inflation, the real inflation figure that considers or captures all the policy changes that have been made recently, will be released on July 15th, because the figure that was released in June didn't capture what happened very well in May. Pronouncements were made on May 29th. So what we're going to see on July 15th is going to set the pace. 9 days after the July 15th, you'll be having a monetary policy committee meeting on the 24th of July. So within that week, that's a key moment where the direction going into the second half of the year is going to be set between the monetary policy committee and then the cabinet that comes in for the new administration. So it's a nice space to watch. But basically, inflation is going to go up from where it's at 22.4. We expect it to push as high as even 25. Will the monetary policy committee react by increasing rate? We can't say. This is the first meeting being held by the monetary policy committee under this new administration. There could be retention of 18.5 monetary policy ratio, for instance, going into the next auction, maybe in September. So after July, you'd have September. So probably just to watch the impact of what the policies are and then to wait for the cabinet, the economic team and all that. So there's a possibility there will be retention at 18.5. And then they could also proactively do another 100 basis point to 19.5. No, those are just the possibilities. But inflation is definitely going to be an uptick, and definitely there will be a reaction from the committee. Yeah.
Yeah, even though the president did harp at the interest rates being too high, his inaugural speech, but we'll definitely be watching out for the first meeting, under this administration. Thank you so much, Mr. Bankole Odusonya, Chief Dealer at Polaris Bank. It was great having your perspective today.
Thank you.